In this week's market update, China soars as trade tariff fears recede, the Brexit endgame begins, big mergers return after a dearth of deals, and a wave of corporate results give investors plenty to chew on this week. The big market story this week is the remarkable resurgence of Chinese shares. The rollercoaster ride for investors in Shanghai and Shenzhen continues this year after the massive ups and then downs of 2017 and 2018. The CSI 300 index, which tracks shares in those two mainland Chinese markets, rose by more than 45% in 2017, then crashed by 30% in 2018. Since the start of this year, however, the market has switched direction once again, rising by more than 25% since the start of January. It's up by about 17% in February alone. The latest surge, almost 6% up on Monday, partly tempered by a small fall overnight, was triggered by a tweet from President Trump, what else, confirming that he is postponing the implementation of sharply higher tariffs on $200 billion of Chinese exports to the US. Those taxes were due to be levied from March the 1st. It's not immediately clear how long any reprieve will be, and indeed, Mr. Trump has probably deliberately left this question open. Mr. Trump said he's planning to meet Chinese President Xi Jinping at his Florida resort, Mar-a-Lago, to, in his words, conclude an agreement on trade. He said that considerable progress had been made in trade talks on issues including intellectual property protection, technology transfer, agriculture, and the currency. US and Chinese negotiators have in fact been engaged in shuttle diplomacy over the last couple of months since the US president raised the prospect of a significant hike in tariffs from 10% to 25%, potentially on all of Chinese exports to the US. This, of course, represents a damaging escalation of the simmering trade tensions between the two countries. And the chance of a full-blown trade war between the world's two largest economies has hung like a black cloud over financial markets since those tensions started to brew last year. And skeptics still question whether the two sides are really any closer to a lasting agreement. The reality is that the complexity of the discussions and the high stakes mean that both sides simply need more time to effectively reshape the trading relationship that has built up over the past 30 or 40 years since China rejoined the global economy. But it's also clear that while the president has sought to play hardball with China, the electoral timetable means that he can't afford too much economic damage in his heartlands over the next 18 months or so. And the need for China to keep growing and manage the fragilities in its own economy mean the Chinese leader is also keen to reach agreement. A reflection of the increased optimism in China is the fact that the Chinese currency, the renminbi, is now trading at its highest level against the dollar since last July. So the good news on trade builds on growing confidence that the Federal Reserve will continue to be supportive of financial markets. On two fronts, it now looks like the Fed has adopted a significantly less aggressive position with regard to monetary policy, and that's a key driver, of course, of financial markets. With investors already pricing in an easier tightening cycle for interest rates in America, attention had shifted to the pace at which the Fed is reducing the size of its balance sheet. This had ballooned in the aftermath of the financial crisis as the US central bank bought bonds to keep a lid on interest rates and boost the economy. But recently, investors had worried that the Fed would sell down those bond holdings too quickly, pushing up yields and so raising the cost of borrowing in America. Well, last week, in its semi-annual report to Congress, the Fed said it did not expect to reduce its balance sheet to pre-crisis levels. That underlined its more dovish stance and gave a major boost to markets, which of course remain in thrall to Fed policy even 10 years after the crisis. Now, usually big mergers are a sign of market confidence, so a flurry of deals this week might be seen as a positive indication of a return to animal spirits in a market rally that has been notable for the lack of enthusiasm of investors. The reality is a bit different. The $18 billion hostile bid by Barrick Gold for fellow gold miner Newmont is certainly a big deal. It would create a gold mining giant, but it looks more like a defensive action to reshape a business that has struggled to find investors despite the recent pickup in the gold price after years in the doldrums. The takeover also looks like a bid to prevent another smaller deal, the proposed $10 billion takeover by Newmont of rival Goldcorp. Barrick's offer is dependent on Newmont dropping its own takeover approach. Another big deal announced this week also looks like a rather defensive affair. General Electric has agreed a $21 billion deal to offload its life sciences unit to Danaher. That's the company from which current GE chief executive Larry Culp arrived last October. The deal is designed to cut GE's debt mountain, which might sound like it's on the back foot, but the price it's secured for the bioscience arm, equivalent to 7 times revenues, pleased shareholders who pushed GE's share price 13% higher after the announcement. Shareholders now are quite rightly sceptical of the claimed benefits of takeover deals, and this week evidence emerged of why they should worry about the so-called synergies that are always used to sell a deal to investors. This week, Warren Buffett admitted for the first time that Berkshire Hathaway, his investment vehicle, overpaid when it merged Kraft and Heinz. Berkshire Hathaway owns 27% of the enlarged company. Buffett was responding to a crash in the food giant shares last week when it emerged that it was being investigated by the SEC, the Securities and Exchange Commission, over its accounting policies. The shares fell by nearly 30% on Friday, serving Mr. Buffett with one of his biggest ever investment losses. Warren Buffett also published his annual letter to shareholders at the weekend, and he took the opportunity to warn that Berkshire may struggle to find what he called the big elephant of a deal that the company needs to move the dial. He said he might be willing to return money to shareholders, something he's long argued against, and which is the ultimate signal that he can't find anything to buy at a sensible price. Now, back at home, it's impossible to avoid the dreaded B word again this week. In fact, the widely flagged high noon for Brexit, represented by this Wednesday's votes on Theresa May's negotiations with the EU, looks more and more like the real thing after a series of anticlimaxes in recent weeks. With the Prime Minister apparently now opening up the possibility of ruling out a no-deal exit against the wishes of the hardliners in her party, and with Labour veering back towards supporting a second referendum, there really is still all to play for. While Theresa May looks to be trying to run the clock down by leaving the next meaningful vote on her deal to March the 12th, just a couple of weeks before the planned departure date, the momentum does seem to be moving back towards those moderates on both sides of the Commons who are seeking either an extension of the timetable or a complete rethink of the decision to leave the EU. MPs will attempt this week to take control of the situation and force the government to rule out the prospect of a damaging cliff edge departure on the 29th of March. With one voice, everyone outside Downing Street and outside the Eurosceptic ERG group of Brexiteers is saying that such a hard exit would be an economic disaster. Now, to take back control from the Prime Minister, they will have to support an amendment from senior Labour figure Yvette Cooper on Wednesday. This demands that if MPs fail to support the government's position by the 13th of March, that's the day after Mrs May's proposed vote, Britain must go back to the EU and ask for an extension. Now, if like most people, you're sick and tired of the political posturing on both sides of the Atlantic, there's plenty to watch out for this week on the corporate front. A few weeks after the US reporting season peaked, company earnings announcements are coming thick and fast on this side of the Atlantic, with a stream of high-profile names lifting the veil on their 2018 profits. There's a house-building theme this week, with numbers due from Persimmon, Taylor Wimpey and Bovis, and Foxtons will add their take on the slowing housing market too. Meanwhile, financials have a good showing, with numbers from the London Stock Exchange, Hiscox and Royal & Sun Alliance, and other well-known names in the spotlight include WPP, Rolls-Royce, Rio Tinto, and tastiest of all, Hotel Chocolat.